Ready to trade smarter? You're making incredible progress. Each step brings you closer to trading like a pro. Remember me? I'm Jane, and I've been trading for a while now. Today we'll explore the different types of analysis that traders use to make informed decisions. Ready to dive in? Let's go! Trading without analysis is like trying to solve a math problem without a formula. It helps traders avoid unnecessary risks and make strategic decisions instead of guessing. Successful traders rely on market psychology to understand what drives price movements. To make informed decisions, they use two main strategies: fundamental analysis and technical analysis. You already have some knowledge of both. Now it's time to explore them in more depth. Fundamental analysis helps traders evaluate a company's financial strength by reviewing its earnings, assets, debts, and market position. It gives a clear picture of a company's value and long-term growth potential. In fundamental analysis, traders first ask, is the company increasing its revenue and profit? Consistent sales growth and rising profits attract investors and can lead to higher stock prices over time. Next, traders check, what gives this company an edge over its competitors? Strong brands, innovative products, or market leadership help companies maintain growth and profitability, making them more attractive to traders. Traders also assess whether economic conditions support this company's growth. High interest rates, inflation, or weak consumer demand may limit profits. A favorable economy, on the other hand, can fuel business expansion. Now that you understand how traders evaluate a company, let's see what you've learned. Knowledge check. Key factors of fundamental analysis. Think like a trader. Match the key factors to fundamental analysis. But be careful. Some options are sneaky and don't belong. Great job! Now that you've learned how to analyze a company's value, let's move on to technical analysis, the key to understanding market trends and price movements. Technical analysis focuses on price charts, trends, and patterns. Instead of financial reports, traders use this information to determine when to enter or exit trades based on market behavior. Every price movement reflects changes in supply and demand. Technical analysis helps traders interpret these movements and forecast future price trends with greater confidence. Let's sum up. You've just taken a big step forward, learning how traders evaluate both companies and markets. Fundamental analysis shows a company's value, while a technical analysis reveals price behavior. Next, we'll take it further by learning how to read charts and spot trends using technical analysis. Let's explore technical analysis. You've seen how important technical analysis is in understanding market behavior. Now, let's take a closer look at how it works. In this lesson, we'll explore the key principles behind technical analysis and how traders use them to navigate price movements with confidence. Technical analysis, as we know it today, began with Charles Dow, a co-founder of the Dow Jones Industrial Average, DJIA, one of the oldest stock market indexes. In the early 1900s, Dow introduced key ideas about how markets behave. Dow believed that market prices are not random. Instead, they follow patterns and trends that repeat over time. His work laid the foundation for technical analysis, which helps traders study price movements to make better trading decisions. Modern traders rely on three key principles to guide their decisions. Let's examine each one closely. One of the core principles of technical analysis is that the market discounts everything. This means all available information, whether it's company news, earnings reports, economic data, or even trader sentiment, is already factored into a stock's price. Imagine a major tech company announces a new product launch and is expected to boost profits. Before you even read the news, the stock price may have already jumped because thousands of traders reacted immediately. That's how technical analysts view the price, as a reflection of all known information. You don't need to hunt down every headline. Focus on the price. It shows you the full picture. Think fast. Traders have to wait for all the news and reports before a stock price moves.
Yes, you're right.
In technical analysis, prices react instantly to news. Traders don't wait. Any new information is quickly reflected in the price, which is why analysts focus on price movements, not reports. Another core principle of technical analysis is that trends persist. This means that prices usually move in a certain direction, either upward, downward, or sideways, rather than randomly jumping around. Your job as a trader? Spot the trend early and trade with it, not against it. Once you've identified a trend, stay with it until strong signals tell you it's over. This principle helps traders catch profits while avoiding premature exits. Quick check. If a stock price has been steadily climbing, the trends persist. Principle suggests that it will likely keep rising unless clear signals show the trend is changing.
Yes, you're right.
Trends persist until something signals a change. So, steady climbing prices usually continue unless reversed by strong signals. Last but not least, you must remember that history repeats itself in the market. Traders often react the same way to price movements, driven by emotions like fear and greed. That's why certain price patterns keep showing up. By recognizing these patterns, you can anticipate future moves. One classic example is the double top pattern. It forms when the price rises to a peak, pulls back, and then rises again to the same level, only to fall afterward. Why does this happen? Traders recognize the pattern, expect the price to drop after the second peak, and start selling, causing the price to fall. Let's check. By studying how prices behaved in the past, traders can often predict how they'll behave again.
Yes, you're right.
Market patterns repeat because traders tend to react the same way to similar price movements. By studying past patterns, traders can better predict what might happen next. Great work! You've just explored the foundation of technical analysis, how price reflects information, trends persist, and history repeats. These ideas help traders read charts with more confidence. Next, you'll learn how to use different chart types to apply what you've learned. It's time to decode trading charts. With the basics of technical analysis under your belt, it's time to dive into the charts. They will help you turn price movements into clear, actionable insights. By the end of this section, you'll know how to read different chart types, recognize patterns, and use them to trade smarter. Let's begin with the most straightforward chart type, the line chart. It links data points, often closing prices, over time with straight lines, forming a continuous representation of an asset's price movement. Line charts are fundamental tools in trading because they offer a clear and straightforward view of an asset's price movement over time. In line charts, you can easily spot overall market directions, whether prices are moving up, down, or sideways. They also reduce market noise, allowing you to concentrate on essential information without distractions from intraday price fluctuations. First, pay attention to the horizontal line at the bottom. It is called the x-axis. This axis typically represents time intervals, such as days, weeks, or months. It allows you to observe how the data evolves over these periods. Now, let's move to the vertical line, the y-axis. It shows the price levels of an asset. It helps you measure how much the price rises or falls. Each dot on the chart is called a data point. These points show the price at a specific time. Next, we connect the dots. Straight lines link each data point to the next, creating a continuous line. By looking at the direction of the line, you can spot price trends. This helps you decide when to trade. Knowledge check. Let's recap line charts. Match elements of the line chart with what they represent. Excellent job! Now you know how to read line charts. You might ask why traders love line charts. First, they make it easy to spot trends. You can quickly see if the price is rising, falling, or staying the same. Knowledge check. You're analyzing the chart. What trend is shown in this chart? Is it a sideways trend, a downward trend, no trend, or an upward trend?
No, the correct answer was
Sideways trend. Not quite. In a sideways trend, the price stays within a range. No consistent higher highs or lower lows. Line charts are also great for comparing. You can overlay multiple assets on one chart to see how they perform side by side. This will help you compare stocks, sectors, or currencies at a glance. As you remember, history tends to repeat itself. Line charts help traders analyze historical price movements, showing how markets reacted to events or economic changes. You now know how to read line charts and spot trends in line charts. But line charts are just one tool in a trader's toolkit. Sometimes you need more detailed information, like how much the price moved within a single time period, or how much trading volume occurred. That's where bar charts come in. Bar charts give you even more information than line charts, as they show not just price direction, but also the opening, high, low, and closing prices for each time period. They're not as popular among traders now, but they're a good foundation for understanding candlestick charts, which we'll look at further. Each bar shows what happened to the price during one time period. The price always opens on the left side of the bar, and it closes on the right side. The top of the bar shows the highest price reached, and the bottom shows the lowest price traded during that time. Each bar shows price movement for one specific time period, like 1 day, 1 hour, or 1 minute. When you put many bars together on a chart, you can see how the price changes over time. Let's read the bar together. Take a close look at the bar in front of you. Can you figure out where the price opened, where it closed, and what the highest and lowest prices were? Don't worry if it feels tricky at first. Just focus on the numbers. What are the opening, closing, highest, and lowest prices shown on this bar?
yes, you're right.
Great job! You've matched all parts correctly and can now read how the price moved. Keep it up! In short, bar charts give you a clear view of market direction and how active or risky the price movement is. In the next section, we'll explore a new chart type that presents this information even faster and more visually: candlestick charts. But first, let's take a quick quiz to review line and bar charts.